The US dollar is facing a historic fall, marking its worst first-half performance since 1973. The dollar index has dropped roughly 10.8% year-to-date, marking the first time since 2017 when the dollar has fallen 6 straight months in a row. So what's causing the decline? Well, mounting expectations of a Fed rate cut and rising concerns over tariffs are weighing on economic growth. Essentially, the dollar is dropping due to uncertainty with the current US administration, leading investors to exchange their greenbacks for another country's currency. However, it's not that simple. Recently, rate cuts in September are beginning to be priced into the market, which would lower rates for almost all US debt that is currently being issued, including the rates that investors can expect to earn from corporate debt, treasuries, and even savings accounts. This has led some foreign investors to swap their US dollars for countries that are offering higher rates, but a majority of people will switch to US equities. Now you may be asking, if they're so uncertain about the future of this country, why aren't they leaving the US financial markets altogether? And the answer is, purchasing US dollar denominated assets, such as equities, can be far more lucrative. An example of this would be a foreign investor who can now purchase a US stock that cost 100 euros in February for just 87 euros today, a 13% discount solely due to the euro appreciating against the dollar. Regardless, all US equity holders should be happy, as this pushed the US markets to end the second quarter on a high note, with all three major indexes notching fresh record highs. It may be hard to remember, but the first week of this quarter saw a steep sell-off following initial tariff announcements. While the S&P 500 may only be up 5.5% year-to-date, we have rebounded 24.5% from our quarterly lows. The Nasdaq and Dow are no different, surging 33% and 17% from their April 8th lows. I think this highlights how strong the current narrative is that we are headed for a stronger economy in 2026. People are expecting AI advancements, lower interest rates, and possibly a resolution to all the trade war uncertainty. Whether any of this materializes or not is yet to be seen, but the sentiment is clear as day. Buy the dip and forget everything else. If we look at a company like AeroVironment, ticker AVAV, we can see just how exuberant the market truly is. This defense contractor, specializing in drones, has been on an absolute tear these past 2 weeks, up 46% to close at a price of $278.07. The surge follows a record Q4 earnings, with revenues jumping $275 million, up 40% year over year, and full fiscal 2025 revenue jumping 14% to $821 million. The company also posted a massive $1.2 billion in bookings and a record $726 million backlog, up 82% year over year. This led many analysts to turn bullish, with recent upgrades to a strong buy and price targets hitting as high as $301 from Goldman Sachs. However, it's not just military tech that's got some love. Fintech up-and-comer Robinhood surged 12% on June 30th to new all-time highs after announcing a major move into tokenized stock trading for European users. The platform will now offer access to over 200 US stock tokens, including private giants like OpenAI and SpaceX, exclusively for EU customers. The jump reflects excitement over Robinhood's first mover advantage in Europe, where regulatory flexibility is allowing the company to expand faster than in the US. It should be noted that token owners will not receive direct ownership or voting rights of the underlying company, as Robinhood will hold the actual shares through a regulated custodian. Investors will instead receive asset appreciation and any possible dividends associated with the company. The markets have taken note of Robinhood's continued ability to roll out new products, including the Gold credit card, 24-hour trading, IPO access, and sports betting. This innovation has led the stock to climb 122% this quarter to a price of $93.63, which brings their market cap to just north of $82 billion. On the macro front, things aren't as positive, as inflation continues to be stubborn, hovering well above the Federal Reserve's 2% goal. The Fed's preferred inflation measure, core PCE, which excludes food and energy, rose to 2.7% year over year in May, slightly above expectations, while headline PCE, which includes everything, also increased, but only to 2.3%. This data is the primary reason why rate cut expectations have been pushed back from July to September. However, we still have lots of time before the next Fed meeting, and a lot can change based on how President Trump treats the July 9th tariff pause. As of June 30th, the US has finalized new trade deals with both China and the United Kingdom. The China agreement, completed in May, includes an 115% mutual tariff rollback, renewed rare earth exports to the US, and a baseline 10% tariff structure going forward. The UK deal, also announced in May, lowers tariffs on US beef and ethanol and sets a 10% cap on up to 100,000 UK car exports annually. This essentially means that the first 100,000 vehicles exported from the UK to the US each year will be subject to a reduced 10% import tariff. This is a significant cut from the previous 27.5% and is much lower than the 50% tariff now applied to vehicles from other countries that have not made a deal. This cap is roughly in line with recent export volumes, which saw about 102,000 cars being shipped from Britain to the US in 2024, meaning a majority of these cars that are being shipped will only be hit with the 10% tariff rate. India is in advanced talks with high-level delegations visiting Washington, though no agreement has been finalized yet. Talks with the European Union are ongoing, while negotiations with Canada were reignited today after the country gave Trump an easy victory by removing the digital services tax they proposed last week. Trump had previously terminated all negotiations with Canada following the announcement of this tax. The US has set a July 9th deadline for trade partners to finalize agreements or face tariff increases ranging from 10 to 50%. With an aim to wrap most of these deals by Labor Day, negotiations continue with 18 trading partners. Surprisingly, no new deals have been reached with any other top US partners like Mexico, Japan, South Korea, or Vietnam.